Now let's discuss the much awaited concept, decommissioning cost. We have a bit of idea on what do we mean by a decommissioning cost. It means that we have a decommissioning liability. We have to dismantle an asset, and for that we need to recognize the provision and the corresponding asset today. Now let's drill down further and let's look at the requirement under IAS 16. Hence, when we talk about decommissioning cost, we talk about three references: IAS 16 for PP&E, IFRIC 1, which deals with changes in the existing decommissioning and restoration liabilities, and IAS 37, which deals with liabilities. So, whenever we talk about decommissioning cost, we talk about these three standards. Now, let's look at the picture and understand the requirement. This is basically a nuclear plant. After 50 years, this plant need to be dismantled. The plant need to be dismantled and we need to make the land as it was before, which means that there's a huge cost that is going to be incurred at the end of 50th year of the lease. What to do now? So IFRS says you need to book a decommissioning liability for that and add it to the cost of the asset, the present value of the cost that you're going to incur, which means suppose you are at the year 0 and after 50 year you have to retire the asset, and here you are going to incur some of the outflow of resources. In this case, calculate the amount up here that you're gonna pay, pull it back to the current year using a discount rate, the present value. So it has two legs. The first is the cost is at year 0. We brought the cost at year 0 using a discount rate. That will form the part of the asset. That will form the part of the asset under category 3. You remember we discussed three categories: purchase cost to bring the asset into present location and condition. The third point is the decommissioning cost. This present value of the outflow will be capitalized under point number 3, and the corresponding credit balance is a liability under IAS 37. It's a liability we need to book under IAS 37. So the entire computation is driven by three major factors. The first one is the future cash outflow of the estimation. We estimate that some outflow is going to happen at the year 50. It may be $100,000 or it may be $500,000. We don't know. We've estimated the amount. That's a major estimate. Second one is the inflation rate. Because I am estimating standing at year 0 after 50 year what I need to pay. After 50 year, which means I have to go through at least 50 cycles of inflation, one cycle per year for the inflation. I don't know the inflation. Hence, it's also an estimation. The third point is the discount rate. It's the discount rate that I'm gonna use to bring back the outflow at year 0 from year 50. So these are the three major estimates that is taken while computing the decommissioning cost. In the next video, we will discuss through an example under decommissioning cost.